Welcome everybody, it's Boris at your College Design Studio, and today I'm bringing you a quick tutorial on bond tables and McCallaway duration. I hope I'm not saying that right. McCallaway, something like that. Um, well anyways, we're taking a look at a zero coupon, a discount, a par, and a premium bond today. We're going to take a look at the differences, and we'll see how to construct bond tables using Excel. That way we can calculate the bond price at the time of purchase, the Macaulay duration, the modified duration, and the present value of cash flows for different types of bonds. And then once you have those tables constructed, if you use it for schoolwork or if you actually invest and use bonds or anything like that, um, all you have to do is type in the information and it should do the calculations automatically for you. So let's get started with the zero coupon bond. In column B, we have years, and it's a little strange. You see 0.51, 1.52, and then here we have period times 2, 1, 2, 3, 4, 5. Well, this is actually our years, years 1 through 14, or no, I'm sorry, years 1 through, not years 1 through 14. This is our periods, period 1 through period 14, and the years are zero point 0.5 through 7. Well, the reason why we do this is because it's a semi-annually compounded bond. So you receive coupon payments instead of once per year, you receive it twice per year, either at the beginning, in the middle, or in the middle and or the end of the year. If it was compounded 4 times per period, then we'd have the number of years multiplied by 4, and we'd have 7 times 4, 28, and we have 28 here. Cash flows for $1,000 of par value. For a zero coupon bond, it's exactly what it sounds like. It's zero coupons. So you receive absolutely no coupons during the duration of the bond. So from year 1 or year 0 all the way through year 7, or the halfway point at year 6, you receive nothing. Either at the beginning or the end of year 7, you receive the value upon maturity, which is $1,000. So say for example, you know that the bond is going to pay out $1,000. You want to find out how much was the bond worth at the time of purchase. And for this, we presume or assume a 5% discount rate. Well, this means that we have to discount the value of the present value of $1 at 5% for all those periods. So for example, starting in period 1, $1 is worth $1 at t equals 0, at time equals 0. At the time of purchase, $1 equals $1. Well, 1 year later, that dollar is worth less than a dollar. It's worth 90 cents or about 91 cents. The reason is because of inflation, rising prices, rising consumer price index, an increase in the standard of living or in the cost of goods sold. A lot of economic and environmental factors change that decrease the value of money. Hence the saying, don't keep your money under a mattress because they're going to be worth less. It's literally like burning your money. That's why people invest their money in the market to receive a certain return and be compensated. So for example, if you have $100 today, 10 years from now or 50 years from now, that $100 is not going to be worth a whole lot. Just think about back in the 30s or 40s or 50s when literally for the monthly pay was $30 to $50 for a lot of people. I'm not sure exactly at what point in time that was true, but there was a time when that was true. And can you imagine living on $30 a day today? That'd be really hard. It's or no, not $30. $3 a day. $30 a month. Yeah, can you imagine living on $30 a month? That's pretty mind-blowing. So the money was worth more back then than it is now because of inflation and different economic factors that have occurred throughout time. Anyways, that was a little distraction. Let's get back on bond tables. Uh, So we calculate this by our present value investment factor. The formulas and the files associated with this you can find in the description of this video down below, or on the BCB Energy website. Just go to bcb-energy.com and click on IT Training Initiative, I believe it is. And then there should be a dedicated web page for IT sample files, where you can download this bond table with Macaulay duration and play around with it. Or you can take a look at some of the equations that we use, such as the present value investment factor, which is, as you can see here, 1 times 1 divided by 1 plus the rate, 5%, 0.05, to the power of C3, which is this right here, and that's a relative reference. As you can see, if it was an absolute, it would be $C, $3. So over here, it's looking at C3, the time period, so it's multiplying it by the time period, adjusted for the number of periods. So it's adjusted for compounding. Always make sure to adjust for compounding. And it goes down the line, 1, 2, 3, all the way to 14. So $1 at t equals 0, discounted at 5%, would be worth about 50 cents 7 years from time 0. That's hypothetical. It doesn't mean that's the way it happens. But in this hypothetical scenario, discounting at 5%, $1 will be worth 50 cents. So supposing this, we have a present value cash flow, PVCF, and that's calculated by D3 times E3. So D3, whatever's in here, times E3, the present value investment factor. And that's given us the present value of our cash flows. Since this is a 0 coupon bond, it's not easy to see what we're talking about. You'll see it for the discount and par and premium bonds. But we have nothing here until we reach the year of payment. So the $1,000 that get paid out at the year that we get it are actually worth $505. So for example, if we were to invest $505.06 or 0.068 cents at t equals 0, we would receive $1,000 at the end of the end of the 7-year period, compounded semi-annually with a semi-annual presumed coupon. Time times the present value cash flows is actually nothing. Don't even worry about this table. This table is here, or this row is this column is here because we're trying to calculate the Macaulay duration, and that is how long does it take for you to receive your investment back. So if you invest, so for example, it's $1,000 you get at the end of the period. You paid 505 at t equals 0. At what point during the life of the bond will you receive that $505 back, not including coupon payments or anything like that? And that would be at year 14 in half years, or if we're talking about periods, so at period 14, or in year 7. The reason for that is because it's a 0 coupon bond. You receive absolutely no payments during the life of the bond, except on the last day. So at the very last day, you receive the $1,000 promised you, which is basically a 5% interest rate compounded semi-annually. And then here we see the same thing, supposing a 4-year instead of 7-year maturity. So you would have to invest $676 at t equals 0 to receive $1,000 at the end of year 4, which means that the current selling price of the bond, or the bond price at the time of purchase would be $676. And the Macaulay duration is, the modified duration is 3.81. That's not necessarily true. It has no economic meaning. I would just look at the Macaulay duration, and that's 4 years, because at the end of the 4th year you receive the $1,000 payable to you. Let's take a look at the discount bond. A discount bond is called such. It's called that because it pays a coupon of 7% when the market rate is higher than 7%. So all that's saying is that the coupon rate of a bond is less than the current market rate. So if the current market rate is 20% and the bond is paying 15%, that's 5% below par, below the market rate. In order for you to want to buy that bond, you have to be compensated for the loss of value. And the way you get compensated for the loss of value is a reduced price at the time of purchase, which compensates for that missed portion in investment. Uh, so we have the exact same scenario, 7 years, semi-annual compounding, and here we have a coupon of $35. That's 7% coupon for 14 periods. So the present value cash flow, half a year from time zero, the $35 you receive is actually worth $33. And we go all the way down here to where we add all of these and we find the present value cash flow of the money you originally invested. So you would have to invest $851.52 at t equals 0 to receive not the coupons and this at the end of the period. So if you add all of this together, let me just do a quick sum, and let's see what we get. $1,490. So if you were to invest 850, if you were to buy a bond, a discount bond of with a 7% coupon rate when the market pays 10%, you would receive $1,490 at the end of the 7th year. The Macaulay duration is 11.04 in number of periods, and number of years 5.52. Now why is that? It's less than 7 and it's less than 14. The reason being is because you receive a coupon of $35 per period. So let's just add this, the $35 before maturity. We'll do it here on the side really quick. We'll do sum, and we'll add all this. $455. So you receive $455 in coupons before maturity, which means that you recover the value of your investment faster than with the zero coupon bond. With the zero coupon bond, you receive no coupons and thus no return on your investment until the time of maturity. For this one, you receive $455 before maturity, which is about a little over half, about $25 over half of what you paid for the bond. So at about period 11 or year 5.52, somewhere around here, you would recover about half the value of your bond, or of the money you paid for that bond. For 4 years, it's a little different, and that's looking at the future. So if for example, if it's an 11-year maturity, and 7 years have expired, this is what these tables basically say. This is the time that has expired, years 1 through 7. This is the time that's remaining upon maturity, years 1 through 4, or years 8 through 11. This will be the price of the bond today. So if you bought the bond at $851.52, at the end of year 7, you would receive this. Say, for example, you no longer want to keep the bond for the remainder of its maturity. If it fully matures in 11 years, then you would sell the bond at $903. So instead of receiving this, you would receive $903. And then the other person that purchases the bond from you would receive coupon payments of $35 per period with a maturity of 1,035 um, at the time of maturity at the 11th year, or for him would be year 4. Um, and he would have to pay $903 for the bond. And that's calculated at a discounted value of 5%. So here's where the discount bond becomes apparent. Always suppose a $1,000 par value. So if the bond is on par with the market, if the market if the market rate is 10%, which is what we're supposing here, and let's go and show you what we're talking about really quick. The bond at the time of purchase and the bond at the time of sale will be $1,000, meaning it's right at market conditions. You don't have to be compensated for a loss of value because there is no loss of value because you're being paid the market rate. You don't have to compensate the company selling you the bond if it's a premium bond. You have to pay over the market rate. So for example, if a bond is paying 12% and the market rate is 10%, then you have to pay an additional $98 to get that bond because it's a premium bond. Premium as in on top of the market rate, 2% on top of the market rate. Uh, let's go back to our discount bond. Discount means that it's discounted at about $150 below par value. So you have to, in order for you to have the desire to buy that bond, which is paying 7%, you can go anywhere else in the market and buy a bond that pays 10%. In order for you to buy a bond that pays less than 7%, you have to pay less money now and receive, in order for you to accept receiving a smaller coupon. Because look what happens. The coupon is $35 per period. Once you go to the par bond, the coupon is $50 per period, and the premium bond is $60 per period. So in order for you to be okay with or accept the smaller coupon payment, significantly smaller, I mean 35 versus 60, and if you buy multiple bonds of millions and millions of dollars, then this adds up pretty quickly. I don't have millions of dollars, so I would know about that. But supposing you do, this would make a big, significant difference. So for you to be okay with this situation, you have to be compensated by paying a lower face value of the bond. Moving on to the par bond, par is exactly what it sounds like. It's on par with the market, 10%, and it's a higher coupon payment than a discount bond. It's not a premium bond because it doesn't pay a higher coupon payment than the market. It pays exactly what everybody else in the market is, whatever the determined value is. The Macau duration is lower because it takes less time for you to recover the value of your investment. So let's do the sum function again. At year 7, you would receive $1,700, and just in coupons, to show you what that looks like, just in coupons you would receive $650 just in coupon, whereas discount bond you would receive $455. You recover $150 over half the value. So for example, you pay $1,000. Macau duration measures when you recover half of your investment. So you recover $150 more than half your value by year 6.5 or period 13. So Macau duration is telling you that at year 5.2 or at period 10.39, so 10.39, somewhere around this period, somewhere between period 10 and 11 or year 5 and 5.5, you will recover half of your invested value, meaning $500, half the $1,000 you invested. If somebody wanted to buy the bond from you at that time and keep it for another 4 years, you would sell it for $1,000 because it's a par value bond. There's nothing to really discount. It pays the market rate, and that person would receive $50 coupon payments for 8 periods. Moving on to a premium bond, it pays 12%, meaning it pays 2% above the market rate of 10%. Again, to show you what this looks like, at year 7, or period 14, if you will, you will receive $1,840. Contrast that to $1,700 with the par bond, $1,490 with a discount bond, and $1,000 with the zero coupon bond. That's why the zero coupon bond is so cheap. It's $505 today, meaning you get nothing during that period, and then 7 years later you get about $500 more than what you paid. This one you pay $851, you get $1,490. Let's see what that looks like. Equals $1,490 minus $851. You get $639 on top of what you paid for with a discount bond. With a par bond, you get $700 on top of what you paid for, which is $1,000, and with a premium bond, you get $840, or no, I'm sorry, about $1,700 and something dollars on top of what you paid for. A little more than a par. But that's why you have to pay a higher price at the time of purchase, because you're receiving 2% on top of the market rate. So you have to compensate the seller for giving you a higher coupon rate. So basically, it depends on what you want. If you need constant income throughout the life of the bond, you would get a par or a premium bond. If a constant income is not a big concern for you, then you would get a discount bond. And if you don't care at all about the amount of money you receive throughout a bond, then you would get a zero coupon bond. The one thing to note is that the elasticity of the bond is what matters here. If you, for example, do you expect market rates to go up or market rates to go down? If market rates go down, so for example, if you have a premium bond of 12% and market rates go from 10% to 8%, that's really good for you, because you paid $10.98. The price of the bond just went up, but you only paid $10.98 for it. If market rates go from 10 to 8%, then you're holding a bond that pays 4% above market rate. If, for example, market rates go up, that's not good for you. You paid more money for a bond that supposedly paid above the market rate. Say, for example, at year 1, market rates jump up to 14%. Well, all of a sudden, your premium bond just turned into a discount bond because it's paying 2% below market rate, but you didn't pay a discounted price, meaning below $1,000. You paid a premium price above $1,000. So some of your earnings, some of the money that you would make, are getting wiped out, which is not good for investors. So it depends on your expectations. Do you expect market rates to increase or decrease? And depends on your preference as an investor, of whether you want a steady income or whether you care only about the money upon the payment upon maturity. Like I said, these tables are available. The links to these tables are available in the description below, and on the BCB Energy website. So check those out if you will. This concludes our tutorial of bonds. And you can do the same thing, I believe, in different statistical packages. Excel, a lot of people have Excel, and it's widely used. It's an easy visual representation of the information, the data. All the calculations and all the formulas for every cell will be included in the description, so you can check that out. Thanks for watching, and I'll see you next time on our College of Design's production.